Okay, so this is the first one that I've actually seen in traffic. So this is a Cadillac Lyric, and this is a 450E, and it's definitely rear-wheel drive because they haven't built the all-wheel drive ones yet. So now this is the first time I've actually seen one in traffic, and now I actually get to see what the thing looks like in traffic. Wow. It's nice. It's obviously a lot different than what is it called? It's a lot different than an XT5. So this guy was lucky he got his. Yeah, lucky guy. I wonder where he got it. He probably got it from Sorrent or Paul Conti. I want to say hi to him. If I can get close enough. Yeah, so mine's gonna be silver, and I'm gonna have 22s. I'm gonna have the full load, 22s on silver with the white interior. I'm gonna try to say hi to him. Fucking traffic, god damn it. Drive fast, you stupid Hyundai. Did you go to Sorrent or Paul Conti?
I had to go out to Smithtown.
I ordered the all-wheel drive one in the same color I got now, and I'm still waiting.
I did three.
Huh?
I did three separate deals.
Three separate
deals. And only one delivered the car.
Just one?
Yep.
Smithtown, huh?
Yeah.
Yeah, I'm waiting for Paul Conti. They said I should have mine by summer.
Yeah.
All right, how do you like it so far? What?
It's gonna be a 24.
20. It's 24. I used to be 23. They bumped it up to 24.
That's what all the deals is.
Yeah, but they give me $5,000 off. But you qualified for the tax credit though.
I don't know.
You don't know?
Income, it's
Oh.
every fucking month. We'll see at the end of the year.
Yeah, how do you like it so far?
I don't have the thing at home. They also give you $1,500 to put the
For the charging system.
Charging in the house, which I just got settled, so they'll be coming over there.
All right. Well, yeah, I'm amazed I caught you on the road, but yeah, it looks good.
All right, good luck.
All right. Yeah, I bet. Yeah, see, I could go to Mercedes. I could get an EQS. I could get an EQE SUV, but I don't want that. And the thing about it is, I think it speaks to the fact that Mercedes and BMW keep on having all these fucking launch parties. They can't even sell this shit because it's like 7 and 8% interest on a fucking $100,000 car. They can't sell that stuff. These things are so ridiculously expensive until they're really, really hard to move. So it is what it is. But I'll just keep waiting because it's like I ain't hurting. I got the SRT Jeep. And it's funny because I have a neighbor and he has 2 Teslas. And I stop by every now and then. I be talking to him. Be like, hey, how's your Teslas doing? And he's like, yeah, they're doing fine. He had a little issue with his Model Y. His Model S was doing great. But he was like, yeah, they've been maintenance free and this, that, and all that. And he hasn't had a problem. I mean, if he had a problem, he would have said something. But my thing is, it's like, I just like, want something really, really, really different. And I like that because I like the XT5. My mom has an XT5. My aunt had an XT5. A couple of my coworker friends had XT5s, and good car. And I like driving it. It's very comfortable. And this, they got heated, cooled massage seats, and then it's electric and shit. And you're not spending $100,000 fucking dollars, $115,000 like you would a BMW or Mercedes. So it's like whatever. It's like I'll just wait. It's coming. It is what it is. This way I can drive through this fucking traffic and not have to pay these high gas prices. Look at this. Well, my gas thing is halfway. Look at this. I'm getting 10.8 miles to a gallon. I've got half a tank of gas since what day? Since Monday? No, since Friday. Or Saturday. I can't even remember now. But this gas, and then the gas is going up because these stupid idiots in my government won't make nice with Venezuela and suck their gas up. So instead, what they do is they cut off the cheap Russian oil. We had cheap Russian oil coming in here. They cut that off. They put sanctions on everybody. Now the gas price is going the fuck up. It's like, nah, I'm gonna have a gas car and I'm gonna have an electric car because I'm sick and tired of these fucking people. I'm tired of them. And then they're about to default on June 1st because of the debt ceiling. $31 trillion in debt. So obviously these people suck as leaders. They don't know what they're doing. They're deep in debt. They're about to go bankrupt. The only thing they could do is spend taxpayer money and call that shit a job. These people are pathetic. If this was back in the Revolutionary time, all of them would have been hung. And they'd have been tarred and feathered. But you know what? These people, they get what they vote for. It's like you keep voting for these fucking Democrats. This is what you get. You get fucking decay. That's what you get. You get what you vote for. I don't want to hear shit. I don't want to hear nobody complain about food. I don't want to hear nobody complain about anything. You voted for it, now you got it. So here we are once again. Federal Reserve pushes interest rates above 5% for the first time since 2007. Federal Reserve raised the target range for its benchmark interest rate by 0.25 on Wednesday, while leaving its options open on future rate hikes. The central bank's move pushed its benchmark policy rate, the federal funds rate, to a new range, 5% to 5.25, the highest since September 2007. The Fed said future rate hikes would be contingent on the impact of previous rate hikes on the economy and financial developments. Federal officials still viewed inflation as elevated and note that they remain highly attentive to inflation risks. As part of the most aggressive rate hiking campaign since the 1980s, the U.S. Central Bank has increased the target range for its benchmark interest rate by 5 percentage points since March 2022. Wednesday's decision was unanimous among voting members of the Federal Open Market Committee, the FOMC, the Fed Committee that decides on the policies. The federal funds rate, this is just a chart showing the target rate upper bound. Federal Chair Jay Powell for the Fed began his press conference on Wednesday with a discussion of the latest developments on the ongoing banking crisis, which last week saw the FDIC broker a sale of First Republic FRC to JP Morgan JPM. Powell said conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. Yeah, sure it is. According to the things that I've read, because of the fractional reserve system and the possibility of people getting panicked and deciding that they want to make a run on their bank, I've heard that roughly half of American banks are insolvent. Half. Now, that doesn't really so much include the very, very, very big, powerful banks, because the thing about it is they have the ability to spin off assets. They have the ability to downsize and whatnot. But from what I'm hearing, it's like half of these banks are insolvent. Half. And that's not good. So they can keep saying how resilient and sound the monetary system is. The problem is it doesn't look good when every single month you've got a bank going under. At least twice during Wednesday's press conference, Powell pointed to the meaningful change in the Fed's statement that swapped in language about the Fed determining the extent to which it may need to raise rates. Previously, the Fed said it had anticipated future rate hikes. Still, Powell sought to maintain flexibility on future policy decisions, saying a decision on a pause was not made today. Powell did say that among members of the FOMC, there's a sense that we're much closer to the end of this than the beginning. I don't personally believe that, but so okay. So Jay Bryson, an economist at Wells Fargo, wrote in a note on Wednesday, the Fed's decision could be termed a hawkish pause. The committee could indeed hike rates by 25 basis points on June 14th, but that decision will depend crucially on incoming data over the next 6 weeks, Bryson wrote. In our view, the bar to a rate hike on June 14 is higher than it has been at past meetings since March 2022. Asked about the possibility of cutting interest rates, Powell said the central bank's views suggest inflation is going to come down, not so quickly. It will take some time, and in that world, if that forecast is broadly right, it would not be appropriate to cut rates. In Wednesday's statement, the Fed said in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. This language replaces the Fed's framing back in March, which had said the central bank anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. The Fed noted that tighter credit conditions for households and businesses are likely to weigh on the economy, hiring, and inflation, though the extent of these effects remains uncertain. The Fed funds rate target range lines up with officials' interest rate predictions released at the March policy meeting, which saw rates peaking in a range of 5 to 5.25% and remaining at that level through the balance of the year. Asked about the impending debt ceiling standoff between the White House and Congress, Powell said that while these are matters for fiscal authorities, nobody should assume that the Fed can protect the economy from the short or long-term effects of a failure to pay our bills on time. So what is all this really talking about? Now, I've made a couple of videos about this already, but it seems that, the only thing that really galvanizes me to actually make a video is when the Fed actually does raise interest rates. Because, see, in real time, I'm actually seeing the effects of the Fed raising interest rates on people themselves, but I'm simultaneously seeing the effects of the higher inflation. When I say higher inflation, I'm basically saying the price of goods is up. The price of services is up. I've watched foods and drinks that used to be like typically $1. Like, for example, if you ever went to one of these stores, you bought a can of Arizona. A can of Arizona was 99 cents. Now it's $1.25. Or packs of gum. Packs of gum are like $2 now. And I think the most staggering increase that I've seen recently that I didn't really expect to see was 2-liter bottles of soda. A 2-liter bottle of soda is somewhere between $2.50 and $3 now, and maybe even higher depending upon where you live. Now, I haven't bought a 2-liter bottle of soda in a while because I say, you know what? If prices are going up, this is a good time to start eating better instead of buying stuff, like junk food, like soda and stuff. But I'm seeing a lot of people being forced to change their eating habits, change their drinking habits, change their smoking habits and whatnot. I'm seeing it happen to a lot of people simply because the interest rates have pushed the prices on stuff so high that a lot of people can't afford this stuff anymore. And maybe it's a good thing. Perhaps this is a good time for people to, reevaluate what they're taking in. Because, it was said a long time ago, I believe it was J.P. Morgan. He said, in a time of recession, all shares return to their rightful owners. I take that to mean that during a time of recession, you're going to be forced to live within your means. That's just one way of interpreting it. I could explain that further, but I think you get the drift. Now, student loans are still paused by the Biden administration, and time is running out because right now it's May. Very, very soon it will be June, and very, very soon it'll be July, and then right after that it'll be August. And these people right now who are already having trouble making payments on, rent and mortgages, they're going to be right back to having to pay student loans. Now, I believe that the government is going to raise the debt ceiling because at this point they don't have a choice. But now that we're over $31 trillion in debt and we've grown a national debt larger than the actual U.S. economy can bear, I just don't know what's going to happen next. They're going to have no choice but to raise the debt ceiling, though. So the last thing they want is to default on the debt. But my guess is austerity of some type is coming. The government, they're going to have to cut back spending. They don't have a choice. There's no choice at this point. There's really no choice. So that's basically what happened in the market. And I noticed that some of my stocks that had been up for the better part of the last couple of weeks. As soon as this, as soon as this notification went out that the Fed was planning to raise rates, I noticed that there was a pullback in a lot of stocks. There was also a pullback in Bitcoin. If you noticed that everybody thought that, Bitcoin was going to the moon, it was going to Pluto, it dropped below 30,000. It dropped to 27 something thousand. I wasn't really watching it all day. I only watched it for part of the time. And that's the bulk of cryptocurrency value right there. That's like over 40% of all cryptocurrency's value is in Bitcoin. That's the reason why most people focus on it. But the bottom line is, I really believe that the Federal Reserve, by raising interest rates and making money not cheap to borrow, they themselves ultimately caused the collapse of SVB. They caused the collapse of every subsequent bank that has fallen into trouble and actually collapsed, including first FRC. I'll just say FRC. So the issue is, it was easy for these people to borrow their way out of the situation at 3% interest rates or lower than that. It was easy for them to borrow. Now it ain't so easy to borrow. It's a shame, because now you really see it, and I'm pretty sure most of you could probably attest. Like, I know people who had leased cars. They leased cars during the pandemic. They're driving these big old, BMW 5s, and they're driving all this stuff. There's, nice cars and stuff like that. BMW 3s, BMW 5s, Audi this, Mercedes that. But I tell you, when their leases ended and they had to bring those cars back and they could no longer release into the newest design because the interest rate was so high that it killed their deal. And if it wasn't that killed their deal, it was the insurance costs also killed their deals. Now they were forced to downsize. So they were forced to go from BMW to Chevy, or they're forced to go to Mercedes to Ford. It's exactly what I was saying. In times of recession, all shares return to their rightful owners. People are being forced to live in their means, and believe me, they are going to keep raising interest rates, and it's only going to get worse. It's like, I think back to the 80s. I had a bank account back then, and I had a 10% interest on my money in that bank. It was Republic National Savings Bank. I had 10% interest. So thing about it is, there's nothing stopping them from raising the interest rates more. The only thing about it is, I don't think we'll see 10, because if the interest rates are raised too high, they won't be able to service the national debt. And if they can't service the national debt because the payments are too high, then what will ultimately end up happening is we actually would default whether we raise that debt ceiling or not. So I just don't see it. I'm pretty sure they're going to do whatever it takes just to keep the ball rolling, for the most part. But it's a mess. This economy is it's a disaster zone. It's an absolute disaster zone. Everybody is deep in credit. They're saying that people have taken out over almost $1 trillion, over 900 million. What is it? Over $900 billion. I'm sorry, $900 billion. They're saying we're almost to $1 trillion in consumer credit card debt. People are financing their groceries. Like, you go into the store and you're taking out a mortgage on a loaf of bread. Like, the shit is ridiculous. It's just absolutely incredible. And Biden is quick to announce, "Oh yeah, I'm gonna run again." And I'm like, you gotta be freaking kidding me. And then you got these idiots in the crowd clapping and everything. It's like, his policies are obviously not working, and you people really are ready to vote for more of this? It's just shameful. It's really shameful. But that is what it is. So Powell's gonna keep on raising these interest rates. Anything that you see that you can't afford already is going to get even more unaffordable. And it is what it is. It is what it is. Now, again, and I think I may have said this in the last video, The only people that this truly, well, when I say this, I mean the interest rates rising. The people that this truly affects are people who don't have much cash. Like, these are people who live on their credit cards. These are people who have revolving debts. These are people who are shopping for a new house or shopping for a new car. For the most part, most people, unless you're running deep revolving credit card debts, this isn't so much a big problem for you. If you're a person who barely uses credit cards at all, chances are you're not going to really feel the impact of all of this. I've heard some people saying that a credit crunch is right around the corner or coming or already here. So my thing is, I recently actually, and I think I made a video about this. I recently increased my credit limit on one of my cards. And bottom line is, if a credit crunch does come, they can always reduce your credit limits to what they think they are willing to cover. But the reality is, it's like, in the near future, it's going to get harder and harder for you to get credit cards, which means if you're a newcomer, it's going to get harder for you to, start building your credit. So my thing is, you might want to start with like something simple, like a secured card or something like that, because if a credit card does come, it may get, difficult for newcomers to start building their credit. That might be a problem. There's other ways to build your credit, though. You can use a used car to build your credit. You can use a new car to build your credit. Those are two easy ways. That's actually one of the ways I did mine. I used a used car loan to help start building my credit. So basically, as I made every single payment on time, it helped me start building my credit history. So that's one way you can do it. Because I you know me, I like to offer solutions and suggestions for people who are, newcomers to the financial system, or what's left of it, I should say. But yeah, don't think that you can only build your credit using a credit card. You can also build your credit using a used car loan, which basically in and of itself is like a credit because it's a mortgage. Or, and this probably isn't you, you can also, if you had to buy a home and you're taking out a mortgage, but you've never had a car loan before, a mortgage can also help you build your debt. The only problem is, buying a mortgage, usually you have to have a decent length credit history for them to consider you. But that's not always 100% true, because there are first-time home buyers who've never had cars before, and there's first-time home buyers who haven't had much of credit card debt before. So it is what it is. The rules aren't set in stone. However, it is possible that there is a credit crunch coming. That is pretty much what happened in between 2008 and 2010. There was a credit crunch. The banks had money that was given to them under TARP, but they weren't lending it out. So, you just have to do what you can to build your credit, protect your credit, and you have to do whatever you can, because right now things are a mess, and as these interest rates go up, things are only going to get more sticky. You may remember a video or two ago, I mentioned the fact that Apple had just launched a savings account for basically for iPhone, iPad, anybody who has an Apple card, iOS users basically. So they're saying, yeah, Apple on April 17th introduced the Apple Card savings account. It turns out that it was highly popular with iPhone users. The new Apple-branded high-yield savings account saw up to $990 million in deposits during the first 4 days of launch. Forbes says that it spoke with two anonymous sources with knowledge of how the Apple savings account performed shortly after launch, but the deposit total has not been officially confirmed by Apple or by Goldman Sachs. During the first day alone, Apple Card owners deposited $400 million. They go on to say Apple is offering a 4.15% APR at the current time, which is appealing when combined with the ease of opening the savings account. Creating an account takes just a couple minutes for those who already have Apple Card, and it works just like any other savings account. You have FDIC insurance for $250,000, just like on any other savings account with any other major bank. There's no fees, and there is no minimum balance. Further on, it says getting a higher rate for a savings account typically requires dealing with a digital bank, and not many popular financial companies are able to compete with Apple on APR. Citibank, for example, has 3.85% rate, and Discover is at 3.75. American Express also offers a 3.75%, while Capital One is at 3.5%. Barclays is at 4. Like the Apple Card, the Apple Savings Account is managed from the Wallet app, and earnings can be tracked through a simple, informative interface. I will tell you this. First of all, I probably mentioned this, I know I have. I make use of Apple Card mostly for paying for extended warranties on my cars. So if I were to purchase a car tonight and there's an extended warranty, if I didn't buy it in cash, I would just put it on my Apple Card, so this way I'd get a cash back up to like, what is it, maybe 2 or 3%. My Apple Card, the problem that I have with Apple Card is that they don't have a clear and defined travel reward system. When I spend on my Capital One Venture card, I get a certain number of travel points. And it was funny because I was showing this to someone the other day and explaining to them about the 1 to 3% cash back. And I was showing them, I was like, yeah, I've saved up so many points that the next time I go on vacation, basically I'll have $1,000 that I can just spend on hotel or condo fees. And that money is money that I earned while spending. See, rewards, I feel bad because a lot of people get suckered into cards with rewards and they don't really understand what they're doing. If you're running a revolving balance, then you're subsidizing people like me who aren't running a revolving balance. I pay off my credit card every single night. If it takes longer for the payment to post, I pay it off every 2 nights. But the bottom line is I don't pay interest. People who run revolving balances, all of these people with credit cards who are buying eggs and milk and bread on a credit card, and they're literally paying a mortgage on their credit card. It's just subsidizing people like me. So the reality is I spend gas, groceries, what else? Computer parts, electronic parts, whatever it is I buy it on my card. And I pay it off immediately just to avoid interest. And the beauty of that is the Federal Reserve can raise interest rates wherever they want. It doesn't matter to me. But the bottom line is I like to use my travel points to travel. Like you can use them. You can use them as instant cash if you want to. You can cash it out and they'll send you a check. I don't do that because you never get a 1-to-1. And that's one of the biggest problems with these reward point systems in the first place. If you have a diner's card, it gives you a 1-to-1 for dining out, like to go out and eat. If you have a travel card, you have to travel to get the 1-to-1. And that's the bottom line. It's like some of these cards, like some people just buy them because they have a cute picture on the front. If you buy a card for an automotive manufacturer, they may say that you only get 1-to-1 rewards if you're getting maintenance or repairs done on a car. So you have to be very careful why you're getting a card. I think the easiest thing you can do is focus on a card that has cash back for rewards travel, because most people want to travel. And the thing about it is, if you save up, like if you spend and you save up enough points over a long period of time, you might be able to save up 2,000 or 3,000 points, and that's $2,000 or $3,000, and you might be able to go on your entire vacation paid for solely by your rewards points. I've done that before. There's a lot of people, most of these guys who you see on YouTube who do travel videos first in business class, a lot of them have upgrades into those flights using their rewards points or their frequent flyer miles. So, you have to really research it a little bit. But it's nice to see that Apple's doing big things with Apple Card. And as an Apple Card user, I use my Apple Card to help because see, you got to understand, you're always building your credit. Even though I have an 850 credit score, there's things that I'm doing to continue to build my credit background, even if I can't exceed 850 as a score. Because ultimately, I'm trying to build 50 years worth of good credit. But it really doesn't matter past a certain point, because once you have 10 or 20 years worth of good credit, you're already A plus. So, keeping my credit spotless, past what 40, 50 years, I mean, that would be fabulous. But it doesn't really make a difference because, there's nothing that you could plan to buy where they're not more going to be focused on your income, or say, basically it's really going to be your income. It's if you ever tried to say if I retire and I wanted to buy a retirement cottage or something down in Florida or something, and I wanted to do it on a mortgage, as my credit history is perfect, and on top of that, my my credit availability, which is helped by Apple Card. I think I have about $11,000 on my Apple Card. The credit availability is also great because it means that at any given time I can charge up to $11,000. If I need something immediately. So it is what it is. But interest rates going up, I'm not interested in paying any interest at all. Last thing I'm going to mention, the biggest winners and losers from the Federal Reserve's interest rate hike. So I'll leave you the link, but it's on pretty much Yahoo News. The more, if you're a new person and you don't really understand financing credit, or you don't understand how the government works and everything, it's worth reading. But basically, it's good research, especially if you don't learn economics where you are, because, they don't really teach economics. If you never learned it before, you're learning it firsthand right now. Savings accounts and CDs. Rising interest rates means that many banks will offer rising returns on their savings and money market accounts. But how fast they do this and how much will vary from bank to bank. So as I was just showing you, Apple is offering you, 4.15, which may actually go up thanks to the interest rate hike. But your savings account is going to offer you a little bit more on your savings, just a little bit more. So that is a winner, and that's a winner in your favor. Mortgages, as far as I'm concerned, are the biggest losers. If you're trying to buy a house right now, the interest rate is going to be sky high. If you're trying to buy a car right now, interest rate is going to be high. So that means that the interest rate could potentially be so high that you'd literally be paying twice as much as you'd be paying had this been 2 years ago, when interest rates are below 3%. There are some people who refinance their houses to 15-year fixed for 2.98. There are some people who bought houses 30-year fixed at 2.98. The banks are literally losing money on those mortgages simply because these people got a killer deal. So mortgages, as far as I'm concerned, they're the loser. Now, as it goes on to talk about, and see, when you research this stuff, this actually helps you to understand it a little bit better piece by piece. But they say the federal funds rate doesn't really impact mortgage rates. Those are largely depending on 10-year Treasury yield. They're often moving the same way for the similar reasons, with the 10-year Treasury yield falling from its highest levels in recent months as the market prices in the potential for a recession. Mortgage rates have fallen alongside them. Now, they talk about whether or not we're in a recession. As far as I'm concerned, we're beyond recession. This is stagflation. So they'll never tell you the truth, because these are the same people who come out and lie to you and say, inflation is transitory. They tell you up front you can't trust them. They might as well have shirts that say "I am a liar" on the shirt. But anyway, stock and bond investors. The stock market soared as long as the Fed kept rates at near zero for an extended period of time. Low rates were beneficial for stocks, making them look like a more attractive investment in comparison to rates on bonds and fixed income investments such as CDs. Bottom line is this: when interest rates were low, people were splurging more and more money into the stock market. They were basically gambling. I'm pretty sure it's going to come up, but the crypto market, as well as the stock market, are both losers when the interest rates go up. However, if you're the type of person who's buying dividend paying stock, the reality is when interest rates are high and people are still investing, more likely you're going to get stable growth because that growth is based on real growth. It's not based on 0% interest rates. 0% interest rates and cheap money create fake growth. Real growth usually happens in the face of high interest rates. It is what it is. So what else they say? Borrowers, if you're a borrower, you're screwed. If you're an existing borrower, don't need to tap the market for money. Say you locked in a 30-year fixed rate, you're in good shape. But everyone else who's looking to access new credit is getting squeezed. Whether that's credit cards, more later, student loans, personal loans, auto loans, or whatever else you might need to borrow for. It's very simple. High interest rates means you're going to pay more to take out a loan. It's just that simple. I don't even need to read the rest of it. Credit cards. Obviously, I don't even need to read this. Credit cards are basically you borrowing money. If you're borrowing money and you don't pay it immediately back, you are getting squeezed. You are a big loser if you don't pay it back before you have to pay interest. The U.S. federal government, well, we already know that as it says with the national debt nearing $32 trillion, the U.S. government is a huge loser. Now, how is this going to go when you have China, which might be 50 or 60 trillion in debt due to the real estate problems they had? How is this going to be compared to, say, Russia, who, America has put sanctions on them left and right in order for them to be just as bad as we are right now? They used to say that America was the cleanest shirt in the hamper. Honestly, I don't know who the cleanest shirt in the hamper is anymore. America's going $32 trillion in debt very soon. And there's a very good possibility we might default unless they, I think there's a point where they can't even raise the debt ceiling anymore. I don't think we're near it yet, but from what I'm hearing is by summer, they could have an issue where they have serious, serious problems. So I don't know. And then they say, now it's funny, they didn't mention cryptocurrency, but I will say this, cryptocurrency is a big loser when the Federal Reserve raises interest rates. Federal Reserve raising interest rates means that money's not cheap. It means that people can't borrow on margin as easily as they could at 0% interest rates. So the reality is the stock market and cryptocurrency both suffer as interest rates go higher and higher and higher. Bitcoin did its best performance during COVID because you had people stuck at home gambling their welfare checks on it. But all that's over now, and I don't think that's going to happen ever again because we're so deep in debt. I don't think they can print anything at this point. But they might figure out a way to surprise me, but I'm just not feeling it. My bet is dividend paying stock. These are my dividend earners. You can see right here. They're mostly gas companies, oil companies, energy companies. You see Sunoco, Verizon, AT&T. They're arranged in order from highest dividend onwards down to the lowest dividend. Now, because I bought gas and oil stock back in 2020 when oil went negative, it basically allowed me to pile up on oil and gas and mining stocks, lithium especially. Just about all of these are up from where I bought in simply because the market basically crashed when we hit, March 18th, 2020. So the thing about it is for people who are new to the market, I always recommend going after the inexpensive dividend stocks. Because the reality is, you're not building Rome overnight. It's like you've got to put money in for a long period of time, over a long period of time. With the dips and this, that, and the other, you have no idea what the market is going to be like 10 years from now, 20 years from now. But what I can say is dividend paying stock every single quarter is going to give you a small amount of dividend repayment based on how many shares you hold. So if you're the type of person who treats your dividend stock portfolio like a glorified savings account, which is what I do, then you basically, the smart thing to do is pick companies that you believe in, Valero, ExxonMobil, EA, whatever. You pick companies you believe in and you slowly invest money into those companies. There are certain companies I think are going to be around a long time. Apple, Microsoft, Google, Amazon. These are the big names that we all know, we all buy from, we all understand. There are smaller companies, there are new companies. Some people are willing to take gambles on those new companies. Nothing necessarily wrong with that. But then again, every now and then you have to be careful because as we saw last year, SPACs, IPOs, they basically ended up being Ponzi schemes to an extent because you had a lot of people who were basically nefariously using these things in order to make money real quick. And then who cared where the stock went? Even if it went into the toilet, nobody cared. Coinbase comes to mind. Robinhood comes to mind. Peloton was a company that their idea was we're going to make people pay a lot of money to ride an exercise bike. At first, it seemed like a good idea when everybody was trapped inside their house and they couldn't go to the gym. But sure enough, as soon as COVID was pretty much declared over, Peloton collapsed. Then there's Airbnb. Airbnb never turned a profit. And during COVID, Airbnb pretty much started collapsing. And then they pretty much never returned to the glory that they were simply because they never proved that they could actually make a profit. So you got to be careful. If you're going to go after stocks, one thing you should do is focus on companies that have proven that they have a profitable business. The whole point of dividends is that you have companies that are paying you a percentage of their profit in order to keep you interested as an investor. That's basically what it comes down to. Crypto does not pay a dividend at all. I don't care what you hear of these idiots talking this bullshit about staking crypto. Those are the people who are in on the scam. They're trying to get your money. It's just that simple. Crypto has no product. They have no profit because they are not profitable. So, it is what it is. But that's basically all I really had to say is the Federal Reserve keeps on raising these goddamn interest rates. And, good luck to the rest of you. Because the thing about it is, they're going to make it so you can't afford just about anything. Like houses and cars are the main investments that the average American makes. Right now, cars are barely affordable and homes are mostly inaffordable. So this is your leadership at work.